All right, we're back. This is Kevin Johnson of Leverage Consulting, and you are listening to the next installment of the Resilient Entrepreneur. So this is somewhat of a part two, even though I said it wasn't going to be two parts. This is somewhat of a part two to the last podcast. And this one is just, when's the last time you talked to your accountant? And here's why. If you remember in the last podcast, I talked about the differences of 2019, 2020, 21, and being very deliberate with your time and productivity. But this really gets to another point with all this, and that is working with your accountant in advance. So the best use of an accountant really is not going to them after the year is over. The best use of the accountant is not bringing them the shoebox or, just sending them your QuickBooks file and hoping for the best. That's not the best use of your accountant. And I'm not telling you to go find a new one, but I am suggesting that if that is not the relationship with your accountant that you have now, then either we need to revisit it or find an accountant that works with you in a more proactive, prospective, forecasting manner, as opposed to more of the shoebox mentality. Because there are things that the accountant should and could be guiding you towards, especially this time of year. And that's the reason why I'm doing it right now. So you really do, if you've not talked to them in recent history, if you don't have a tax forecast for the year end, or a short list of strategies to help you minimize your tax consequence for 2021, it's time for you to go write an email and do so like now, today, this week, something. But you really need to take, for example, and this is something that I'm actually helping facilitate for a few clients. So essentially, right now, what you should be doing is writing an email to your accountant asking for a tax forecast for the year of 2021. They will need to look back at maybe the previous 1 to 2 years. And again, as per the last podcast, 2020 is somewhat of an anomaly. 2019 would probably be somewhat of a benchmark for you. But again, that's assuming, that's right, I'm assuming, but that's assuming that 2019 was a normal year for you. And quite honestly, many of you may have had things where, for example, you bought a big piece of equipment and had a huge write-off. Maybe it was a crazy productive year. There are things that change every year from a business standpoint that affects our taxes. And again, all the more reason, because it's not just based off of how much did you collect or how much did you write off or expense. Let's just say, we're not even going to say write off. We'll just say how much money flowed out of your business versus how much flowed in. Even if you had 3 years that looked fairly similar with those two things, the incoming and the outgoing money, that doesn't mean your taxes are going to be exactly the same each year. And in 20 some years of doing what I do, it's always interesting to get those phone calls from clients on, the second week of April, and their accountant just called them and told them they need to write a check that is 5 digits, sometimes 6 digits. And, I don't know about you, but most of them are not happy about having to write checks like that. I've never met anyone who loves sending money to the government. I think all of us would rather have that money sitting in our own account because it's something we can do something with, whether it's fund our retirement, fund our kids' college education, something that's productive and productive for us. So that being said, it's really important to reach out to the accountant now. Figure out what our tax consequences right now, the way it looks, what we're tracking for, have you paid enough in on your estimateds, and what can we do between now and year end to minimize our tax consequence. And they could have a host of strategies. These are not recommendations for you. These are just ideas where I'm throwing mud at the wall right now. But it could be that you're considering buying a new piece of equipment. Well, maybe you can buy that new piece of equipment, make that investment, and maybe the accountant can expense the entire thing this year. It's possible that you could fund retirement. It's possible that you could, any number of things. I mean, literally, there are retirement funds that between your accountant and maybe even your financial advisor, you could get together with the two of them and figure out a way for you to minimize your taxes. So, as I said, this is somewhat of a part two to the last podcast. This one is super important because, again, I've never met anyone who loves the unpleasant surprise of, oh, by the way, you need to write a really big check to the government, both the federal and the state. If you are working with them on an ongoing basis, and I'll tell you that most times when I talk to clients about their relationship with the accountant, they might say, well, I haven't talked to them since I've done my last tax return. Yes, they come, they work on my numbers, and they send me a report every month. And this is not saying your accountant is a bad accountant. What this is saying is the relationship is not right. And it might be, and it's not a matter of pointing fingers or trying to point fault at you or your accountant. Quite honestly, at this stage, it doesn't matter. What does matter is making sure that we make the relationship right. Because just getting a financial statement at month end or quarter end doesn't cut it. It's not a tax forecast. All it does is it might help you with your profitability. It might help you understand your cash flow, but it is not necessarily, that's not a tax forecast, because the other piece of this is you have your business, but then you have your personal side of things. I have a very good friend of mine. He has a very successful business. His income has gone up compared to the previous year. He also sold his home. He's been living in a rental while he's building another home. His tax consequence is not going to be the same as the previous 2 years. So there's been a lot of changes. So when you're doing these things, we need to not only figure out the changes and the tax consequence of the business, but also figuring out how that applies to the personal side of things. And again, the other strategies might be, they might suggest that you take additional payroll, or ultimately it's either has to come through payroll or it has to come through estimated payments. So that is your Resilient Entrepreneur podcast for today. It's really an important one. It's not one I got really, wound up on today, but for many of you, it could be one of the most important podcasts you've listened to in recent history. And like I said, if you've not talked to your accountant about a tax forecast and getting one done in the very near future, I would highly, highly recommend it. By the time you listen to this, you'll have really about 1 to 2 months, ultimately 3, where you'll be able to do something about this. But it's a short period of time. And when you throw in a handful of holidays and a few other things in there, that time is going to pass really, really quickly. And technically, you've only got 8 to 9 weeks to make some of this stuff happen. So with that said, that was your Resilient Entrepreneur podcast for the day. Hope you enjoyed it. As always, if you have comments, questions, or other things you'd love for me to cover, please feel free to reach out.